welcome to this week's MFB News. I hope everybody has had a fantastic week and you were able to get out and enjoy the beautiful sunshine if you had it over the weekend. We did. I was out in it for about 10 minutes, got sunburned because obviously my lily white skin hasn't seen the sun for about a year. So spent the next couple of days in agony. Never learn, do we, no matter how old we get. Now, in terms of what we've got for you today, we're going to do our usual look at what's been happening with swap rates, lender pricing. We're then going to do a bit of a data exercise today. I'd love to do this as a quiz actually, but obviously that wouldn't work very well in terms of the format of this. But we're going to be sharing lots of data with you this week in terms of the performance of both the UK housing market and also the private rental sector. And there's some fairly interesting statistics in there, stuff that you don't come across every day, which I thought would be really interesting to share. So without further ado, we're going to move on to swap rates. And no great news here actually. So as of 10:45 last night, so today is Wednesday, so this is Tuesday evening, 2-year swaps 4.387, 1 month ago by comparison 4.406, and 1 year ago 5.495. So month on month things are slightly down on 2-year swaps, and year on year obviously significantly down, sort of circa 1.3% lower, so that's really positive. 5-year swaps, a slightly different story actually. So 5 years as of last night, 3.897. 1 month ago, 3.844. So actually we're a little bit up month on month. But I mean, the difference is so tiny, I wouldn't read too much into that at this stage. Year on year, 4.718. So circa 0.9% lower year on year. So what it feels like with regards to the data today is that 2-year swap rates have actually come down and 5-year swap rates haven't. So I think that kind of implies that we are expecting an imminent base rate reduction, according to the markets at least. As I understand it, there's still kind of a chance that we're expecting base rate to come down in August, but I think the kind of view is that we're more likely to see that in September now. So in terms of lender pricing changes, so as you can see here, from the swap rate data, pricing hasn't really moved in the last few weeks, but we are still seeing lenders pricing down. Now, some of these lenders are lenders that just simply hadn't priced down previously, so they're now playing catch up with the rest of the market. But actually, looking at the list of names, there are a few repeat reducers on the list. So these guys are maybe just taking the decision that they're going to take a shaving off their margins, so make less money per pound that they would lend back out to you guys. Maybe that's why they're able to make these reductions. So what have we seen? So we've seen Virgin drop rates by up to 0.1%. They're definitely a lender that's repriced in the last few weeks. The Mortgage Works rate reductions of up to 0.25%. That's not insignificant actually, particularly with the Mortgage Works, who are arguably the UK's largest buy-to-let lender. So when these guys make such a large reduction, of course, the rest of the market's going to take note. Clydesdale rates reduced by up to 0.7%, and that's huge, way out of kilter with what anyone else is doing, so please don't get excited. Why have they been able to make such a large reduction? Clydesdale haven't repriced in absolutely ages, and when swap rates went back up again most recently, the most recent incarnation of swap rates going back up, which has been so many incarnations now, they were quite aggressive in their increase, so I guess they've been able to just bring things down to a more manageable level. So that's really the clearing banks, the high street institutions. And these guys will have a funding model that's kind of mixed between lending out savers money essentially, and also the capital markets, so swap rates. Looking at the more specialist lenders now, whose model is very much reliant on the money markets, the swap rates, not necessarily entirely, but largely. So first of all, keep your eyes peeled. Kent Reliance have announced they're making changes today. They haven't released those yet. But for anyone who's got an application in with Kent Reliance, it's worth knowing about this. Because as you guys will know, because I bang on about it all the time, if you've got an application in with a lender and they bring their rates down, you can ask to move on to the new lower rate. Some lenders will charge you a small fee for doing so. I mean, we're not talking 3% of the loan amount or something. We're talking 0.3%, something. I'm sorry, £150, something like that. So if you have got any applications in with Kent at the moment, this is worth knowing about, keeping your eye on the rate changes that are coming out later on today. We've seen Aldermore reduce their 2-year fixed rates. These are now from 4.99% for multi-property applications, so one mortgage application secured against multiple properties, and 5.09% for single property applications. And these rates come with a 3% arrangement fee. Paragon have launched some actually very good 5-year fixed rate limited editions, which come with a flat fee of £2,995. Now, these mortgages or rates are only available for those properties which are a single self-contained unit. And as you guys, I'm sure, will be aware, Paragon can lend on HMOs of up to 20 rooms and multi-units up to 20 self-contained units. This is for those single units. But the rates are actually very good because we're able to lend to limited companies. So if you've got a green property, so EPC rating of A to C, your 5-year fixed rate here is from 5.45. And if you're non-green, so D and above, then you're looking at 5.5%, so very good. We've also seen rate reductions from the Skiptons, they're for home loans, the Kensington, HSBC and also NatWest as well. So things are certainly edging their way down. Like I said, we do need swap rates to kind of move a bit more than they have done, and actually week on week 5-year swap rates have actually increased a bit, which is unhelpful. Just to recap, as a kind of guideline for you, so lenders need to charge circa 2 to 2.5% above their cost of funds to really make it commercially viable for them to lend you the money out, because they have their own overheads, and banks are not charities, as we well know. So realistically, if they're paying 3.897 on 5-year fixed rates to get the money in to lend it back out to you, the overall cost of interest needs to be at least really 6%, maybe even slightly over that, for it to be commercially worth them doing it. But I think, you know, broadly speaking, positive news. Like I say, we probably will keep seeing lenders making tweaks to their pricing. We've been saying this for a few weeks now, but actually any kind of sizable reductions, which are going to really make you guys sit up and take note, is going to be reliant on swap rates coming down. Time will tell how that's going to shake out. We have the base rate meeting in August and one in September. And obviously also we're waiting for ONS data to come through with regards to inflation as well. All these things kind of go into the melting pot in terms of where fixed rates are going. Okay, now a quick look at the latest ONS data on house prices and rents. People like the ONS because it's kind of very, very independent. There's no kind of agenda. They're not an estate agent or anything like that. So what have the ONS got to tell us? So the average UK private rents increased by 8.6% in the 12 months to June 2024. Now that is down from 8.7% in the 12 months to May 24. So one could take away from that the rate of rent increases is still increasing hugely at 8.6%, but it's not increasing as quickly as it was. Average rents increased to 1,310 in England. That's an average of 8.6% growth. £743 in Wales, that's 8.2% growth, and £959, which is an 8.4% growth in Scotland in the 12 months to June. In Northern Ireland, average rents increased by 10.3% in the 12 months to April 24. In England, rent inflation was highest in London at 9.7% and lowest in the northeast at 5.9% in the 12 months to June 2024. So in England, London's seeing the highest rate of rent inflation at the moment. Now, house prices, average UK house price increased by 2.2% to £285,000 in the 12 months to May 2024. That's up from the original estimate of 1.3%. So house prices have grown much more strongly than people were expecting them to. Average house prices increased in England to 302,000, that's an increase of 2.2%. In Wales to 216,000, that's an increase of 2.4%. And in Scotland to £191,000, that's an increase of 12.5%. And that's in the 12 months to May. So average growth across the UK is 2.2%, but if you break it down by each kind of area, as it were, there's some differences in there. It does go on to say that in recent periods, the total transaction volumes and new build volumes available to calculate the UK house price index estimates have been lower than usual. So that shows that actually it's just a much quieter market. So while they're fishing from a data set, that data set is smaller than it would typically be. Now, in terms of regionally on house prices, and going down to kind of rural regions now, Yorkshire and Humber was the English region with the highest house price inflation in the 12 months to May, up with a growth of 3.9%, up from 1.2% in the months to April. So Yorkshire and Humber have seen a big step up in terms of their house prices. Annual house price inflation was lowest in London. Conversely, they're seeing the highest rent inflation, there you go, with an increase of 0.2% in the 12 months to May 2024. This was up from a decrease of 3.6% in the 12 months to April 24, on the first positive annual growth in London since May 2023. So I think in terms of what we can take from this, it really does feel, I mean, there's always going to be kind of, you know, discrepancies here in terms of house prices when you go very sort of localised. But broadly speaking, even the regions which have been over the last 12 months really, really struggling and now starting to see growth again, which really signifies that actually the property market probably has now bottomed out and is starting to return to growth. And that's before we kind of see the return to autumn, when naturally you see a kind of flurry of activity, before we see base rate reductions, which will really reassure the market and get things going as well. So I do think that actually, and I've said this, often, if you are thinking about investing, and I've got quite a lot of clients who are like looking at the kind of overall picture and saying, now is the time to do this. So just to kind of give you context, if you bought a property now, there is a chance that you would pay more for it by the end of this year. You can apply for a mortgage and your mortgage offer is valid for 3 months. So let's say it takes you a month to get your mortgage offer and your offer is valid for 3 months. Some lenders it's 6 months incidentally. Then essentially we've got a kind of 4-month window between starting the process and your mortgage offer expiring. 4 months from now takes us to November. So during that time, if a lender did reduce their mortgage interest rates, as we talked about a little bit earlier on today, you can then ask to move on to the lower interest rates. So you can secure a property to buy at today's prices, but you can apply for a mortgage now. And yes, okay, the rates are probably still higher than they're going to be by the end of this year, but you can move on to a lower rate later on as well. So there is a kind of real argument for saying that actually now is probably a very, very good time to get shopping for those of you who are thinking about investing. Okay, now this is the bit that I would have loved to dearly do as a quiz for you, but it simply wouldn't work because TMW have released their private rented sector report. And I just find it fascinating. I mean, I'm a massive bore when it comes to stuff like this. But actually there's some data in here that I think will be really interesting to anyone who has a kind of interest in the property market more broadly. So the first thing they tell us is that the share of households in the private rental sector in England has broadly been stable at circa 19% in recent years. So 19% of all households in the UK are privately rented, and that's been fairly static. Now, there were around 4.6 million households in the private rental sector in 2023, which is a little bit below the peak of 4.7 million recorded in 2017. However, this relative stability comes after a sustained period of rapid growth between 2000 and 2015, which saw the number of households privately renting double from 2 million, so 10% of households, to 4.3 million, 19% of households. This was more than twice the rise in the number of owner-occupiers, which increased by 1.1 million between 2003 and 2023. So what we can see here is that, first of all, the number of properties available in the PRS grew rapidly over a period of 15 years. That number of properties has really sort of stabilised now, but as a percentage, the number of rental stock, as a percentage of UK housing stock, increased far, far more rapidly than privately owned stuff. Now, this period of rapid expansion was fueled by the decline in long-term interest rates. Remember those days, guys? Which, along with favourable tax treatment, and also remember those days, made investment in a residential property increasingly attractive. The emergence of the buy-to-let mortgage market opened the sector to a wider investor base. Since 2003, the number of buy-to-let mortgages outstanding has increased by more than 1.5 million, though the majority is still owned outright. And this is fascinating. 60% of private rental stock in England is unencumbered, so has no mortgage on it at all. I wish I was one of those people, sadly not. The structure of the rental market has also changed enormously, notably in terms of the demographic profile of renters. And one of the most dramatic shifts has been among those aged 55 to 64, where the number of households privately renting has increased by 80% over the last decade. I wonder why that is. I don't know if it's down to something like divorce and family breakdowns. Anyway, while this partly reflects growth in the number of households in this age category, the proportion renting has also increased by almost 50%. And this correlates to the ongoing decline in home ownership amongst 55 to 64-year-olds, which is now around 10 percentage points below its peak in 2007. So in London, more than 30% of households rent privately, almost double the proportion of the rest of England. So London is the most kind of highest rented region. London has traditionally had a higher share of renters, but the proportion of renting has more than doubled since 2004. This reflects the impact of intensifying affordability pressures for prospective first-time buyers, where the price of a typical home in London is now twice the UK average, compared with circa 50% higher in 2000. Indeed, the proportion of households owning with a mortgage in the capital declined from around 40% to 25% in the last 20 years. Now, the landlord population has also changed. There has been a marked change in the ownership structure of the market, and composition of landlord portfolios. Data from the English Private Landlord Survey in 2021 shows that just under half, so 43% of all landlords owned one rental property, a significant shift from the situation in 2010 when almost 80% of landlords owned a single property. Similarly, the proportion owning 5 or more properties has increased from just 5% in 2010 to 18% in 2021. The latter have a disproportionate role in the market since they account for almost half of all tenancies. As you might expect, landlords operating as individuals usually have smaller portfolios than those operating as companies or organisations, and more than half of landlords operating in a company structure own 5 or more properties. Absolutely fascinating stuff. Now, the other thing that I just found quite interesting, there's a little kind of pictogram here, which I'd love to show you, but essentially what they're showing is the percentage of private ownership of different types of properties and the percentage of ownership of different types of properties if it's in the private rental sector. So in terms of flats, first of all, so in the private rental sector, 49% of rented properties are flats, whereas just 9% of privately owned properties are flats. In terms of bungalows, 4% of privately owned properties, rental properties, and 8% of privately owned properties, I had to put my teeth in this morning, are bungalows. Now, in terms of detached houses, so just 3% of private rental stock is a detached home, whereas 26% of privately owned stock is a detached home. And in terms of terraced homes, 35% of private rental stock is a terraced house, whereas 28% of privately owned property is a terraced house. So it really just kind of shows the kind of different types of stock that people own and lean into when it comes to renting versus private ownership. So there you go, lots and lots of data in there. I hope that was kind of interesting. I find this sort of stuff fascinating, but it's probably because I'm actually just really boring. But actually just to kind of see how the private rental sector is moving and evolving in terms of property types and demographics and property ownership, all that kind of stuff, which really just feeds into the greater landlord community. And that's us wrapping it up for yet another week. They come around quick, don't they? So look, if you have any questions, you can always give us a call, 0345 345 6788. I genuinely hope that you're not going to be calling us in the next week, because I actually hope you're going to be jetting somewhere hot, sunny and all-inclusive. But if, like me, you're sadly not, and you do have a mortgage question, we're definitely on hand to have a chat. Do look after yourselves, and I'll see you same time again next week.